All right, good morning, everyone. I think we'll get started now. I'm sure we may still have a couple of people that join us as we get going here, but my name is Steve Kalina. I'm the President and CEO of the Minnesota Precision Manufacturing Association, and welcome to our session 4 of the CBIZ series on successful business transitions, today on ESOPs. So this program will be recorded and available for later viewing, but first I'm going to go through just a few pieces of housekeeping. I want to congratulate the first cohort of our Skilled Training Academy that had their graduation 2 weeks ago at Hennepin Tech, and we've actually got our third cohort starting on August 17th. So that's really exciting, and been a lot of interest, and the students have been doing fantastic, and it's just really fun to see the progress they've made, as well as the employers and the progress they've made in their internal training programs and apprenticeship and communication and all that. August 19th, so just a week from today, we've got another toolbox talk with Federated Insurance on distracted driving. On September 9th, we've got a kind of a new approach we're taking, partnering with the Printing Industry Midwest, PIM. They've got a young professionals, young leadership group that meets every so often, so we're partnering with them to get that going on our side, and having an event at the St. Paul Saints game on September 9th. Also, September 28th is our 10th annual Shoot for Scholarships clay shooting match that raises money for our education foundation. You'll no doubt see a lot of CBIZ people at that event. They typically have some pretty good shooters that show up, and it's just a fun, casual outdoors event, raise money for scholarships. And then just to promote kind of an exciting new feature, we've got a special edition of our magazine coming out just after Labor Day. It's focused on workforce development and lots of solutions, specific things that companies can take to the shop floor. So we think manufacturers are going to be excited to read some of the solutions that their peers have come up with. So it's all peer-based rather than a consultant writing an article or something like that. And then we have a specific call to action too for all readers to have just one conversation, to take some of the content, which some of the content is actually geared towards students, and take that and share it with a student, a teacher, a neighbor, your own child, just anyone that you come across that you think could learn more about manufacturing. So we're going to encourage everyone to just, whether you read the magazine cover to cover or not, just take a moment and share it. We actually tagline it as the issue that you won't want to hang on to, that we want you to get rid of it, to hand it off to someone else and have a conversation. So with that, today's program, again, sponsored by CBIZ, or put together by CBIZ, focuses on ESOPs, or employee stock ownership programs. As many of you know, ESOPs provide a great opportunity for business owners who are looking to make their transition, but yet still kind of leave their legacy, leave their the culture, and give an opportunity for their employees to grow with the company. So Sue Crockett is the executive director of the Minnesota Center for Employee Ownership, Minnesota Center for Employee Ownership, and is going to lead the discussion today, along with presenters Roger Bang of Diversified Plastics and Andy Daly of Saul, Ewing, Arnstein, and Laird. As Lacey mentioned earlier, we've got a Q&A function in the Zoom, bottom of your Zoom screen. So feel free to use that anytime. If it's something very pertinent to what they're discussing at the moment, we can break in and ask that question. Otherwise, we'll have a Q&A session at the end. So with that, we'll get started. And I want to welcome Sue Crockett. Sue.
Thank you. Let me get to the beginning of my PowerPoint here. Sorry about that. Yes, good morning. And thank you, Steve and Sarah, for allowing us to participate in this session today about in your succession planning. One of the reasons we wanted to present to MNPA is that, even though ESOPs are great for any industry, manufacturing tends to be the sector that most ESOPs are created, and usually over 20 employees, but it's kind of interesting that it is manufacturing. So we thought this is a good area that we could help to educate business owners and other professionals on what an ESOP is, what it means to a business owner, to their employees, and to their community. So let me just begin by starting out here with introducing us. That's me. I'm the executive director of the center. I spent 30 years with the ESOP Association, and in January of 2020, we started the Minnesota Center for Employee Ownership. It's actually started by the Employee Ownership Expansion Network, which is based out in Arlington, Virginia, to create state centers across the country Minnesota is the second one. And our purpose is really to be the boots on the ground, to educate and be a resource for business owners and professionals. The other speakers with me today is Roger Vang. He's with Diversified Plastics. He's the CFO, has a lot of experience and was very involved in the transition to their ESOP, and he's going to be sharing his story for Diversified. And Andy Daly, an attorney at Saul Ewing and Arnstein. Also, Andy's been, I know him a very long time, both Roger and Andy actually, through the ESOP Association, and is an ESOP attorney and very experienced in this field as well. So who are we? I think I just talked about that. The boots on the ground, we're a 501c3. We're not membership driven because we want to be just a resource to anyone who needs us. And that helps us build trust within the community and also to understand our culture here in Minnesota, which I think is helpful. So our mission is to turn the state of Minnesota into a place where every working person can be an employee owner. And some of the data that's out there today is really quite alarming when you look at the future for Minnesota. 52,000 business owners in Minnesota are over the age of 55 and probably will be exiting their business in the next 3 to 5 years. In the data study that we did, 60% of them said they did not have a plan, and 40% said they didn't even know what their options were. So we want to be able to tell them what their options are out there to find out what might be the best fit for them if they're thinking about exiting their business. Because you can't say you have an exit strategy. If you don't have a strategy, you don't have an exit strategy. So this is where I can see this series is really helpful to business owners to just start looking, and are you prepared? And are you, what do you want when you actually, exit your business? So there are actually 3 forms of employee ownership that we support. Employee stock ownership plans, which we're going to talk about today. Worker-owned cooperatives, which is not your grocery store or dairy cooperative. It's where the workers actually own the business and they profit from it while they are in the business. And then employee ownership trusts, which is not very well known in the Midwest, but gaining some momentum. I mean, it's been used on the East Coast and the West Coast, where it's a little bit like an ESOP, but it doesn't have some of the same benefits that an ESOP has, like tax. And and it's not a retirement plan. That's what I was trying to say. ESOP is a retirement plan. EOTs are, you make the money again, like profit sharing while you work there. So that's a little bit about MNCEO. So I'm going to turn it over to Andy to start to talk about ESOPs, but I also want to make this as interactive as we can. And so if you have questions, I think Steve and Lacey are going to be monitoring those. Feel free to just raise your hand and say, there's a question, and we'll answer that as we go along and try to make this as informative and meet the needs of the attendees. So thank you for joining us, and I'll turn it over to Andy.
Thank you, Sue, and I am happy to be here today. I'm going to give a high-level overview of what an ESOP is and how it works. Then I'll talk about some of the benefits of employee ownership, and finally, we'll get into some of the characteristics that make a company a good fit for an ESOP. So the first thing, as Sue mentioned, is that an ESOP is a qualified retirement plan. And so as such, it is in many ways just like a profit sharing or a 401k plan. But of course, there are some significant differences. 2 of the big ones are 1, that an ESOP is designed to invest primarily in employer stock, and 2, that an ESOP can borrow money, and they can borrow that money to purchase that employer stock. And so just like a 401k plan or another type of qualified retirement plan, ESOP assets are held in trust by a trustee. The ESOP trustee is appointed by the company's board of directors, and an independent trustee with ESOP experience is usually appointed for that initial ESOP stock purchase. But after the transaction, the initial transaction, either the independent trustee can be kept on, or some companies at that point will move to an internal trustee if there's somebody within the company that has the necessary experience to take on that role. So the ESOP trustee is the shareholder of the ESOP shares for the benefit of the plan participants, so that the employees of the company do not become direct shareholders in the company. And so the ESOP participants don't have all the rights of shareholders. And there's no requirement to allow employees generally to participate in company management or decision-making. Although some ESOP companies exercise open book management, there's also no requirement that the company share financials with employees. There's no minimum purchase for an ESOP. It's not unusual for an ESOP to go to 100% ownership right away, but smaller purchases or even just a contribution of stock to the plan, to the ESOP, is permissible. And so again, as a qualified retirement plan, the ESOP must provide for broad-based participation and is subject to minimum vesting and eligibility requirements. And so subject to certain exceptions, new employees are generally able to participate in the ESOP after satisfying the plan's eligibility requirements. And that eligibility requirement is often 1 year of service. But the eligibility and plan entry looks similar to, the choices you made in setting up your 401k or profit sharing plan. And similar to those plans, participant accounts must be fully vested at or before 6 years of service with the company. And so what service counts for vesting? So you have the choice of whether to count service for vesting purposes prior to the adoption of the plan, or you can set it up so that everybody has 0 years of service for vesting when the plan's adopted. And so you have some flexibility in how you treat that prior service when you set up and design your ESOP, as long as the same rules are applied to all employees. And so next, an ESOP is typically a 100% employer-funded benefit. Employers are not required or permitted to make contributions to the ESOP, and so the ESOP is fully funded by the company out of the future earnings of the business. And so once contributions are made to the ESOP, whether in cash or stock, they're allocated to participant accounts based on annual compensation. And as mentioned, employer stock may be purchased by the ESOP with a loan. And in that case, the shares purchased are held in a suspense account. They're not all allocated to participant accounts immediately, but they're allocated as that loan is paid down. And as that loan is paid down, those shares are allocated ratably to the accounts of current employees based on current compensation. And as a qualified retirement plan, like a 401k plan, an ESOP is subject to IRS and Department of Labor oversight and reporting requirements. For example, annual 5,500 filings must be made for the ESOP. The DOL also has oversight over ESOP stock transactions, including the initial purchase, which is one of the reasons why it is very helpful to have a professional independent trustee approving the purchase of shares of the company. And while there is no minimum size requirement, as Sue mentioned, it usually takes around 20 to 25 or so employees for an ESOP to make sense. And there are a couple different reasons for that. One is, due to certain compliance testing requirements, particularly for S corporations, you need to have enough participants in there to satisfy those requirements. And, the costs of setting up and administering an ESOP, being able to split those among, a larger group of employees. And so if you have considered an ESOP, or if you've already adopted an ESOP, I encourage you to get involved in the ESOP community, where you will find a very supportive group of companies building employee ownership cultures. The best way to get involved is participation in events through the MNCEO, the ESOP Association, and the National Center for Employee Ownership. And please, if you have any questions about any of those organizations, feel free to reach out to any of us, and we can talk to you about that. Next slide, please, Sue. So an ESOP is not right for every company, but when it works, there can be a lot of benefits that range from tax savings and liquidity for the selling shareholder, tax savings and productivity gains for the company, and an improved workplace culture and the building of retirement savings for employees. There we go. ESOPs are flexible as to the timing and size of purchase. Owners can gradually cash out if they wish. And while companies often go all in with a 100% ESOP purchase from the outset, there's no requirement to do so. So for example, if the current owner wants to maintain majority ownership for a period of time or indefinitely, or if there are multiple owners and not all are ready to sell, an ESOP could still be a viable option. You don't have to have all shareholders go along with the sale to an ESOP. You can have some stay on. Maybe, for example, you have one or two owners who are ready to retire, and one or two others who are still, have a long runway with the company and want to maintain that ownership. ESOPs require little change in corporate structure or governance. As mentioned, having an ESOP does not require you to give employees a say in the day-to-day operations of the business. Note that if you are currently operating as a partnership or as an LLC taxed as a partnership, the company will need to be converted to a corporation to adopt an ESOP, either a C or S. There may be limited circumstances where an LLC works, but we don't need to get into that today. And it's very specific facts where you're essentially operating as a corporation, even if that's not your corporate or your business structure. And so tax benefits. ESOPs have significant tax benefits. Contributions to the ESOP, whether they're in cash or stock, you can contribute shares directly to the ESOP, are tax deductible. And when an ESOP purchases shares with a note, that note is going to be repaid with company contributions. The company will make a cash contribution to the ESOP. The ESOP will turn around and repay that loan with that contribution. And the full amount of those contributions, even the portion that's reused to pay principal on the note, will be tax deductible by the company. If the ESOP sponsor is an S corporation, I don't think X corporations have been invented yet, any income allocated to the ESOP is not subject to federal or Minnesota income tax. And so this tax savings can free up cash to repay debt and reinvest in the business. And when talking about this, I'd like to point out that this is not a tax loophole. This tax exemption for S corporation income allocated to ESOPs was specifically put into the law back in 1998 and has remained in place since then. And this is one of the reasons why so many companies go to 100% ESOP ownership, because as an S corporation that's 100% owned by an ESOP, you operate without any income tax. If the ESOP sponsor is a C corporation, then the transaction can be structured for the selling shareholders to defer or avoid capital gains taxes on the sale of stock to the ESOP. If among those the requirements to do so, the ESOP has to own at least 30% of the company immediately after the sale, and the proceeds have to be invested in qualified replacement property, which generally means stocks and bonds of domestic operating companies. So the capital gains tax would be due upon the eventual sale of any qualified replacement property. But under current law, if you don't need the proceeds from the sale to live on, of course, if that qualified replacement property is held by the selling shareholder until death, it will receive a step up in basis, and capital gains taxes on the sale of the company will have been avoided entirely. Finally, an ESOP can be a powerful tool to improve employee recruitment, retention, and engagement. And recent studies have shown that employees of ESOP-owned companies enjoy greater job stability, wages, and benefits than employees of comparable companies. And ESOP companies are better able to weather economic downturns. Studies also show that employee owners have amassed meaningful retirement savings through their ESOP accounts that will give them the means to retire with dignity. Next slide, please, Sue.
Mhm.
So if this sounds good so far, you may be wondering how to know if your company is a good fit for an ESOP. One of the questions we often get is which industries work well for ESOPs? And ESOPs are found in pretty much any industry, and as Sue mentioned, are particularly well represented among manufacturing companies. As previously discussed, an ESOP must be sponsored by a corporation. And an ESOP can be a good fit if the owner or owners are looking to the long-term future of the company. Maybe the owner is getting ready to retire and there's no good option for ownership succession. A third-party sale may be possible, but that third-party sale could result in employees losing their jobs. And an ESOP may be a way to keep your employees in place and the company in your community. An ESOP purchase also requires that the ESOP trustee has determined that the purchase price is not more than fair market value. And so one of the other questions we often get is, if I sell to an ESOP, does that mean I'm, selling at a discount? And not necessarily. So if you have a third party buyer who is a synergistic buyer that, feels like they can get more out of the business than it's currently getting, then maybe that third party buyer would be able to pay a premium. But by definition, an ESOP can pay fair market value. And so for this purpose, the trustee will engage a financial advisor to perform an appraisal on the business. And having a history of profitability can be helpful when performing that appraisal. A stable profitability generally means less risk and more certainty in future cash flows, and that will likely be reflected in the valuation, which will often primarily rest upon at the discounted cash flow method valuation, among a couple others. And sometimes, even if an ESOP is the right move, the timing might not yet be right, and it could be best to wait a year or two for a variety of reasons. But one of those reasons could be putting up a couple of good years of financials, cleaning up your books, that sort of thing, and getting ready for that sale, which is true whether you're selling to a third party or to an ESOP. And so, as mentioned, ESOP contributions are allocated based on current compensation, and a stable payroll base is helpful when estimating the value that will be provided by an ESOP, while projecting benefit levels and compliance testing when you're doing a feasibility analysis for whether an ESOP will fit for your company. Another thing is, if you're struggling with employee turnover, an ESOP may help drive retention and recruiting if the benefits of the ESOP are properly communicated to your employees and prospective employees. Studies have also shown that ESOP companies are more productive, and at least a part of the reason for that seems to be, the employee ownership mindset and what can be unlocked when employees understand how what they do on a day-to-day basis affects the value of the shares in their ESOP accounts. I mentioned earlier that you don't have to share your company financials with the ESOPs or with ESOP participants, your employees, but the employees do see the stock price, the annual stock price. So the stock price is generally just updated once a year, and they see where that's going and can kind of see how, when things change at the company, how that stock price can increase. And the transition to an ESOP may be smoother if your company already has a sort of ownership culture, understanding how you can impact where the company goes, but an ESOP can certainly help in enhancing or establishing that culture. And so sometimes the selling shareholder continues to run the business following an ESOP sale. In other cases, the selling shareholder is ready to retire and move on. Regardless, the ESOP trustee will want to ensure that management is in place going forward when approving the transaction. If not, the risk of who's going to be running this company will be reflected in the valuation of stock, or perhaps even in the ability of the trustee to approve the deal. And so having that successor management in place is critical for an ESOP, because of course, when you're selling to a third party, they might put their own leadership team in place, but that's not the case with a sale of an ESOP. So you need to have that ironed out. And so to give you a real life example of this process, Roger's now going to walk through how this process worked for Diversified Plastics, how they went through the process, how long it took, that sort of thing, and what the ESOP has meant to them. Roger?
Okay. Actually, can we just pause for a second and see if there's any questions that we can answer, talk about for right now? I mean, Steve, or do you have anything to?
Sorry, trying to find my unmute. Well, first, the primary question is to learn more about these X corporations. That'll be interesting to learn more about. But
topic for another day, Steve.
One quick question I had was, you mentioned a couple of times, Andy, on ESOPs aren't required to share financials with employees, but yet they can kind of figure it out a little bit. Do you find that most ESOPs do share their financials though with the employees?
I don't know if I would say most, but a lot do, absolutely. And it can be, either very high level. There are quite a few ESOP companies that basically share the entire financial statements with the exception of individual compensation, just having one line item for compensation rather than breaking it down. But yeah, a lot of companies do share all the details, which of course can be helpful, limiting expenses, where we can find certain efficiencies and how that can really plug into what the stock price does each year.
One question posted here too is just about how, when the employees get money, the benefit related to their ownership.
Yeah, so it is a retirement plan. So generally not any benefits until they leave the company. And so if an employee stays with the company until retirement age, which will be defined in the plan, and could be 65 or something like that, they'll be eligible to take their first distribution no later than the year following the year they retire. and those distributions can be paid in installments over 5 years. So it's not like a 401k plan where everything's liquid assets. It is primarily invested in employer stock. And so recognizing that the IRS and Treasury have set up the rules so that distributions can be spread out generally over 5 years. If you leave before retirement age, there can be a 5-year wait before you can start receiving distributions.
The other thing I was going to add, Andy, too, is that in ESOP companies, when people retire, I mean, they have retired actually with 6 figures, 7 figures, based on being involved in ESOP. So it really is a way to create some wealth equity for that across the board for all employees in a company. And I think that's the good news about an ESOP.
I think that's all we have for now, so you can keep moving along.
Okay, all right, then I'll turn it over to Roger.
Great, thank you. Good morning, everyone. What Andy described is essentially exactly what we went through as far as how to set up our ESOP. So I guess my job is to basically flesh out the story as to what we went through and follow along. Diversified Plastics is a custom injection molder. We've been in business since 1977. We recently acquired a company out in Vista, California, Pacific Plastics, which operates the same way. And then we have our own design tool and engineering, which manufactures the steel molds for our presses locally in-house. And next slide, please. And so again, we have about 104 employees now. We have about a 53,000 square foot building in Brooklyn Park. We have another 45,000 in California. So again, that's kind of a quick background on us. Next slide, please. And then the industries we serve, filtration. Those are the types of products we make. We make components for other manufacturers, whether it be filtration, end caps, or electrical plug-ins, medical supply items, and some industrial. And we've been doing that mostly for things that require tight tolerances and maybe engineered plastics. Next slide. Again, this design tool, and you can see example of the molds that they make. Next slide. And then again, we also do a number of services, assembly, insert molding, over molding. We have a clean room for assembly of medical supply. And then also we've established Acceleration Station, which is a 3D prototyping facility that can build tight run, short run, production ready parts without using the steel molds. And we can turn things around quite quickly if you have just a very limited quantity you need. Next slide. And so they talked about ownership culture, and this has been a big part of it. We do have monthly meetings with our employees. We do go over a number of things, including financials, but we try to emphasize at every meeting what our core values are. And this has been long before we were an ESOP, but we really are involved with our customers. Our employees are very important. The families of our customers, over there you can see a brand new baby was added to the family here recently. And then of course the ESOP, but also the environment. We are one of the only plastic manufacturers in the state that has ever received a Green Star Award from the Minnesota Pollution Control Agency. And our people are very active in the community, whether it be the local food shelves or Toys for Tots or Raking for the Elderly, a number of Chamber of Commerce attendees and colleges as well. Next slide, please. So how did we do it? Go ahead. Started off with Jim Dow being the owner of the stock on it. So the first thing we did was we established a trust, and the owner sold 50% of the stock to the company directly. Then the next step was that we sold the remaining 50% to the ESOP trust. Go ahead. And so ultimately then
Let's see. Sorry.
100%. There you go.
Next.
So as far as funding, basically, like Andy said, Diversified Plastics did borrow the money to purchase the stock from the owner. Then this Diversified Plastics then loaned the money over to the ESOP trust in order to pay the owner. The trust then paid the cash out to the owner. And that took care of the 50% that was purchased from the trust. The treasury stock amount was a note directly to the owner from Diversified Plastics. And why we did it that way was a combination of things, but just to try and make sure that we had the proper cash flow available, and then also to make sure that liquidity and collateral values were acceptable to the bank. Next slide. And so for our people, they had been around for quite a while, so we started anybody that had already been employed at the company was immediately vested at 100%. Jim Dow wanted to reward all of those people that lived through all of the hard times and the tight times, sticking with them all those years. So that's why we put them in immediately. Any new employees are vested over a 5-year period, similar to what Andy was talking about. And again, the funds can only be taken out when the employee leaves the company or retires. And then the payments are made based on the last company evaluation, which is prepared by an outside valuation company. And we started out making lump sum payments when the amounts were smaller, but as time grew on, they started getting bigger. So now we're doing it over a 5-year period. Allocations to the individual accounts, again, are taking your salary divided by payroll to come up with a percentage. And then that's the allocation factor that we use for any distributions. And then, of course, it is stock. So we try to make sure our people know that the valuation can go up or down based on the outside valuation. And if there's any need or a determination at any point, we can make additional contributions if needed. And so this was one of the slides we did for our employees when we first did it. People were wondering, well, what changes in here? Everyone's employment remained the same. In fact, the next, roll it up. There were no management changes. The president or the former owner actually remained as president for a number of years. However, he's not eligible to be included in the ESOP contributions in order for tax purposes to address that. So, and then we also had a profit sharing program or a bonus schedule, and we said we'd continue doing that, as well as the 401k. Some do combine their retirement funds, and we decided not to. Next slide. So here's the timeline. It started way back when. And in 2006, we first met with our CPA at that time and decided that it really we weren't the right size at that point to really look at that. The owner was looking at different options for succession planning. So then we looked at an MBO, a management buyout scenarios, where we had a number of key managers that have been very effective in the company, and approached them over time to see if they had any interest in getting together and buying the company from Jim Dow. We put it all together, and in October we presented it formally, and it took him about 30 seconds, and he said, "That's not the number I had in my head, so no thanks." And we moved on from there. And then, of course, the Great Recession in 2009, we actually had a couple of different companies approach the owner suppose, looking for a deal because things were down. And actually, one of them actually come up with a letter of intent, which surprisingly was done almost exactly the way we calculated it back the year before. And so that wasn't accepted either. So we looked at, I got a chance to actually meet with a banker involved with ESOPs and evaluation expert, and really helped define it better for me. And we agreed at that point that we weren't quite ready yet, but it really gave us a good background on that. And then I gave it one more try to see if the managers wanted to try and do a management buyout again. But by that time they had sent their money in different locations. And then spring of 2011, we had a very good fiscal 2010. And so we kind of scratched the numbers together, and it did look this time that evaluation appeared to be possible and get close to that magical number that was in the owner's head. And so with that information, we started holding interviews with ESOP attorneys and banks to look to see if this was feasible of what our scheme was. After going through that process, we decided that yes, it was still a good idea. So we proceeded starting in July with the due diligence, and a decision was needed at that point to change banks. The bank that we had been involved with for a long period of time really didn't get the ESOP concept and was really kind of against it and trying to discourage us, quite honestly. Primarily because I think they had the owner personally guaranteed on his house, his summer cabin, his firstborn, and everything else. So they didn't want to give that up. We did the legal documentation in the next couple of months, including a formal valuation and getting the plan documents all written up. And then in the end of September, we actually closed the sale. We made it retroactive to the beginning of our fiscal year, which was November 1st of 2010. October 31st was our year end. We had been a corporate or a C Corp, and starting the next fiscal year, we became a sub S for the reasons that Andy described. And so November, after the deal, we had wanted to announce this to our employees going forward. And it went something like this. I guess we're got one.
Okay.
That's all right. Key points learned. You want to have a reasonable expectation and forecasted financial performance as to how you're going to cash flow this. By going to the sub S tax deferred method of corporation, that freed up cash for us to be able to finance the deal. And again, not all banks understand or are comfortable with ESOPs, so you may have to make a decision there. ERISA regs apply, and next slide. Due diligence is similar to a third-party sale anyway. I mean, you want to make sure that as the trustee is comfortable that this really is a good deal and the expectations for the future performance of the company is there. And it is expensive up front. There's also the recurring costs of evaluation and compliance reporting that Andy had referred to. We tried to do a bundled approach, and by that I mean we met with valuation companies and the bankers and the attorneys and found out who they had been working with on a repetitive basis, so that there was a comfort level there and we didn't have to reinvent the wheel. I mean, the way people wrote stuff, the banks understood and had an agreement to it, so we stayed as boilerplate as we could, and we got everyone to kind of agree to keep the prices down a little bit. So I think we saved quite a few $1,000s by grouping it that way. And the continuity of the business operation is extremely important. And again, that's the same with any sale of a company. But even though we approached our customers and said, no, management's the same, we're going to do everything the same, president's the same, there was still a lot of customer anxiety there that we really had to kind of handhold them through this process to make them comfortable that things weren't going to change dramatically. And again, like I said, the company was started in 1977. We're doing this 30 some years later. You don't want to underestimate the significant personal impact of the former owner. In our case, the closing on September 30th, we thought everything was just a matter of let's sign here and move on. There was really some last minute angst on the owner's side, just last minute concerns that finally his attorney just said, I'll just sign it. And make sure that you have the proper corporate structure. Again, Andy had talked about that the sub S allows you to pass the earnings through to the trust without any tax implications. And then you have continuous and correct communication with your employees going forward. And as we've been taught by Sue and her group and over the years, it does take several years for people to really get the ESOP. And so you want to be patient on it. You want to keep bringing the ESOP into the conversation as much as possible. Okay. And valuations. Well, it helps to understand how companies are valued in the current marketplace. And again, the valuation company does help you with that. The ownership needs to have a reasonable expectation as to the value of their baby. Again, when we started this process, the numbers that were calculated and the number that the owner had in his head were a long ways apart. So we wanted to make sure that you're in the right place. But ultimately, you got to have a reputable valuation firm as needed for the IRS to accept the numbers used. And before we go into that, I just want to, Andy had referred to the IRS and the Department of Labor are the two groups that basically are looking at these deals. And as a business owner, the best way to describe it is that the IRS is going to look at you and say, that dirty rotten scoundrel is trying to lower the price and avoid income taxes. The Department of Labor is saying that dirty rotten scoundrel is selling the price too high to the employees and making them pay too much. So that's why it's really important to have that reputable valuation firm coming up with something that's accepted by all of the parties involved. And ultimately, in a privately held company, the value is the figure that the owner will agree to, the banks are willing to finance, and again, it must fall within the valuation company's range of values. You typically see a number of different types of methods that they come up with the values, so it's not just one, and they give you a range. So how did we announce it to our employees? Well, we told them that there's a required meeting on it, and we had in front of the office or in front of the building was a man that they were familiar with sitting in a suit, and the president's talking about, I'm not getting any younger, it's about time to look for succession. And then he said, I'd like to introduce you to the new owners. And then this slide came up. Thank you. When we were first talking about this, you could feel the air go out of the room, basically, with the employees saying, oh no, what's going to happen? There was one lady that was crying in the back, but then we came up with this slide. And the man in the suit was basically the ESOP attorney we had at the time, and he was there to help explain what was going on. And one of the first questions out of their mouths was, well, I can't afford this. How much is this going to cost me? And so we have a lot of diversity in our company. So we put up this slide as well. Next. And so people ask me, has it been good for the employees in the company? Andy had referred to ESOPs do very well with productivity. And you can see from this slide that even in 2020 with the COVID stuff, we still eked out a little bit better share price on it. So there's 2,000% increase since we originally did this deal. So yes, it's been very good to our employees. I've had a couple of our employees that have retired now with, $100,000, $200,000, $400,000 worth of ESOP retirement funds on it. So with that, that's our story. And like I said, it follows very closely to what Andy referred to. And if anyone has any questions, feel free.
To say that's a pretty cool story too. Just what you just talked about, Roger, and the first day when you kind of that moment where you announce to the employees, and it's pretty special that again, that feeling of engagement and ownership and feeling like they play a part in it. That's pretty cool. So, and I don't know, Sue, do you want to kind of move to some of the questions that are more geared towards just kind of the general? I mean, there's some questions that are probably more general that either Roger, Andy, or yourself could answer. I could just throw them out there and then.
Yeah. So I think one of the things I'm asking Roger this because I'm not sure, but when you've made your acquisitions, did having the ESOP allow you to do that because you were not paying the taxes on the profit of the company? It allowed you to grow and acquire other companies and make other companies employee owners.
Absolutely, it did. We were able to, with the business doing so well over those first few years, we were able to pay the bank off much quicker. So we were freeing up that cash from former tax liabilities on it. So that helped us look at acquisitions much faster than what we anticipated.
Mm-hmm. Andy, what are some questions that you often get that you might not have covered in your presentation?
One of them that I often get, which is helpful in the context of how long this took for Diversified Plastic, as Roger outlined, is how long does this process take? And of course, the answer is it depends, but sometimes it does take, the 10-year process that Roger explained, but a lot of that timeline, or excuse me, it wasn't 10 years, but 5 years or what it was. But a lot of that timeline is really just getting the company ready to sell in general, whether it's an ESOP or another third party. The process of, once you decide you're going to go with an ESOP and you the owner kind of has a sense for what the value is and is willing to accept that, it's months, not weeks, but it doesn't necessarily take years from that point once you're ready to sell.
So Roger, what would you, if there was a business owner or even the professional that's on today, what would you say at the end of the day to a potential seller or to a professional when they're helping their client? That makes it the most important piece of changing or selling to employee ownership.
I think the culture is extremely important. You need to have ownership that's respectful of their employees and cares about them, and the employees having understanding of that. So there's a mutual respect on that. That's a big component of making successful ESOPs. If the employees believe that this really is something that they're going to have benefit in over the course of time, it's like they kick into a different gear and you'll see a lot of improvements. And I think the stats indicate that productivity in ESOPs are typically higher than than other companies, and there's a reason for it, because they can see the benefit for themselves and in their retirement and for their families. So I think having a good culture is probably one of the biggest things to do with this. It is a recruiting tool, no question. We've had some very good luck with getting people's attention, you know, when we start talking about that. During employment interviews, I got to catch myself. I start getting kind of excited about it when I start rattling off what we've done. And it's been very helpful for us in that way.
Mm-hmm.
It also gives us an opportunity when you're doing acquisitions down the road too, which is maybe a little off pace, but when you start talking to the owner that, you know, you're going to be selling to an ESOP, that they have tax advantages if they're in the right corporate structure as well. So that means more money left in their pockets. And that does give you a little bit of a leg up on some people.
Mm-hmm. You know, one of the things that I think always comes up, and you did allude to this a little bit about the cost of an ESOP. And I know sometimes the question comes up, well, it's more expensive to put in an ESOP than it is to sell to a private seller, to private equity. And I don't believe that that's true. I mean, there's going to be costs on either end. And Andy, do you have some insight onto that you can add to that question?
Yeah, I mean, it's a very good question. And yeah, I mean, an ESOP isn't cheap. It is the sale of the business. And so, you know, an M&A deal to a third party isn't cheap either. And so the cost can vary quite a bit between transactions based on a lot of different factors, the complexity of the transaction, how many selling shareholders there are, those sorts of things. But I think the cost overall is probably pretty comparable to a third party sale. It might end up being more expensive than a management buyout, but it's going to be comparable to a third party sale, and it could be less expensive if you're using a broker to sell your business. So it really depends on the structure.
Yeah, but I think that's one of the misconceptions. One of the misconceptions about an ESOP is the cost.
Yeah, I mean,
it depends
if you're comparing it to setting up a 401k plan. Well, yeah, I mean, it's much more expensive. If you're comparing it to selling your business to a third party, then you're kind of in the ballpark.
Well, and then the other thing about ESOPs too is, you know, they usually the company is diversified, so they will have a 401k. I mean, not everything, not all the stock or not all the investment is in the ESOP, and I'm sure that stems back to Enron and when all of that went down, that every company is going to have more diversification.
Yeah,
yes?
That's right. Yeah, ESOP companies are more likely to have a 401k plan than non-ESOP companies. And, you know, for most of them, they had their 401k plan before they adopted the ESOP. And like with Diversified Plastic, they generally stay the same. Oftentimes, you know, if they're making employer contributions to the 401k plan, those may stop or be reduced and be replaced by the ESOP contributions. But generally, the overall employer contributions will go up with an ESOP, even if they're being reduced in the 401k plan.
Mm-hmm. Yeah. So I think at the end of the day, if we were just trying to do an overview, I mean, we've got the technical side of it, and if anyone wants to go deeper on the technical side, more than happy. Andy's happy to answer more questions, put you in touch with a valuation company, with a CPA. I mean, we have those resources available, and we're happy to share that. Also, we have many stories like Rogers, and Diversified's a great ESOP company, and they're always willing to share a story and, you know, the good and the bad and the ugly, to help other business owners learn, because the power really is in a story, especially for a business owner, to learn about what was really the reality of that all that came down. And, you know, the data does show that ESOP companies do have more longevity, they pay higher wages, they don't lay off as often or as much as a non-ESOP company. So I just think there's a lot to look into as an option in a succession plan. So if there's, are there any other questions, or Steve, how do you want, you can wrap it up. I mean, we're about 10:55 and
Yeah.
happy to answer more questions if there's any.
Yeah, if anyone else has any, you can throw them in the chat or the Q&A real quick. But real quick for you, Sue, I guess, I think especially our MPMA members and manufacturers in general always love hearing about their peers. And I know when we talk about, oh, here's a lawyer you can utilize, or a CPA firm you can utilize. I mean, when they're MPMA partners and resources, or I know that, my peer down the street uses them, I automatically trust them more. So hearing, Roger and Diversified Plastics story is great. And like Kurt Manufacturing, of course, one of our founding members is an ESOP. So at some point, you don't necessarily have to recite them now, but if you know of other manufacturers that you can share with us, whether they're resources that people can talk to, or just even knowing who all are ESOPs, because I think some of us may not realize some of the companies that are ESOPs, and it's great to hear their stories. And again, Diversified Plastics is a fantastic company that's doing great things, and I've been there a few times, and just a testament to what Roger talked about, and just talking to their employees, it's a different atmosphere. I mean, they're engaged, they're just to a different level than most companies, and they're doing some pretty cool things there. So it's not that that's all because of ESOP, but it definitely helps.
Yeah, and on our website, and I can certainly send you a link to this, we have a directory of ESOP companies, and you can actually put in the industry. So go in there, put in manufacturing, and it'll give all the ESOP companies in Minnesota.
Yeah, when we send out this
Yeah.
recording, maybe we'll make a point to share that link, because I think that is a great resource.
Yeah, definitely, because you're right. It is nice to see who else is out there and who you can talk to, because there's more credibility in talking to a former business owner or to a company that has had an ESOP for a while, even more so than to start with a professional. So definitely would be happy for you to take a look at that. Also, I sent the PowerPoint in a PDF format to Lacey that can be shared as well. That's why we kind of went into more detail with it, so you'd have something to take with you. And I understand it's also being recorded and will be up on YouTube as soon as it's edited. So that's another great thing to share with your members, and I'll share it with mine as well.
Perfect.
So thank you for the opportunity to be able to share today, and thanks Andy and Roger, and thank you Steve and Sarah and Lacey for making this all happen. Appreciate it.
Yeah. Well, you did all the thank yous. There's not much to close out, but thank you, Sue. It was a great presentation. Thanks for collaborating. And again, thanks to CBiz for putting this all together. So great to hear the stories. And I know personally, looking at our family business transitions, I think, an ESOP is something that is definitely of interest. So great thing to talk about, talk openly about. So I encourage everyone to do so.
Yes. Great.
Thank you all today, and look forward to seeing you all soon.
Okay. Thanks.
Thanks, everybody.
Bye.
Bye.